Yeah, good morning, friends. So we will start now. I mean, in fact, today, this time, before doing any introduction, I would first like to just take a small poll. So if you guys can just participate in this poll, that do you think the markets are in a bubble zone? So this is our first question, and I'm sure we'll find some interesting answers in our interaction with Sandeep. We have around 200 people who have participated. I mean, we'll wait for another 10-15 seconds. So please try to give your view, and I'm sure we can get some interesting answers. So we will just stop in 10 seconds. Okay. Very interesting. So Sandeep, I hope you can see the result. We are saying 68% of the people think that the markets are in a bubble, and 32% think that it is not in a bubble. So okay, we leave that as it is right now, and then we will. So I will. A very warm welcome all of you today for our monthly session on the markets, and I trust that all of you would be fully vaccinated by now. I hope that we don't see a third wave as being tom-tommed around. In this whole melee which we have seen the market witnessing a new high. The Sensex has now, as Amarnath was saying the other day, that it has now become a senior citizen at 60,000, and Nifty is just short of becoming a major at 18,000. So I think maybe in a day or two, hopefully it will cross. We have seen this journey of the Sensex from 50,000 to 60,000 has been one of the fastest in the history of BSE. It, I think, just took around 166 days, so just under 6 months. The longest time period, just for people who are interested in statistics, it was from 20,000 to 30,000, which took about just about 5 years. It took around 1,820 days. So you can, that was a period between 2007 to 2015, just to get a sense of it. So we are seeing, greed and fear is at its height, and we are forever plagued with the $1,000,000 question. Are the markets heated? Are they expected to go up or go down? Do we exit or should we enter? Are we in for a correction? The Evergrande crisis in China was also being tom-tommed as the Lehman moment. We don't know what is going to pan out over there. China has just recently banned cryptocurrency, saying it's illegal. So amongst all this frenzy, we are also seeing one of the highest retail participation in the Indian equity markets, and the new millennials seem to be taking over the markets. These are the times where we wish we could see what is in store in the future and take our actions accordingly. But sorry, that is not going to happen. So it is amongst all this euphoria that we have the privilege to have with us today Sandeep Tandon, who is the CEO and CIO at Quant Mutual Fund. Quant has taken over the business from Escorts Mutual Fund in 2018, and they have seen phenomenal growth in the last 1 year. Its pure equity AUM has increased from what was around 100 crores a year back to just under 3,000 crores. And this has happened purely on the basis of the superlative performance and the management. So my heartiest congratulations to Sandeep and his team. So Quant, I have been very intrigued that they have been, having good three core beliefs, which they have, you can even check it out. They call it fundamental, which is like the Atma. So an individual cannot exist without his Atma. So without fundamentals, the value cannot persist. The next core belief is liquidity is like prana. Prana is life, right? Liquidity basically imparts value to the assets and to the organization. And the third one is the sentiment, which is which Sandeep defines it as the Maya. So Maya is the illusion. It's created by our minds, and the price is an ever-changing perception of economic value created by investors. So we have seen the current markets being driven by liquidity and sentiment. Fundamentals, are we getting better now? How it will pan out, we do not know. So to decipher all this, we could not think of a better person than Sandeep. Sandeep has nearly 3 decades of experience of the equity markets and is purely driven by data and its analysis. Uh, Quant has also had the distinction of their small cap fund, the multi cap active fund, the absolute, which is an aggressive hybrid, and even the infrastructure and the tax saver fund. All these funds have been at the #1 position in the last 1 year. So fantastic feat by Team Quant under the astute leadership of Sandeep. So I will not take up much of your time and hand over to Sandeep to explain how Quant has been able to achieve this feat and what is Quant's investment framework in the current market scenario. We will have a Q&A after that. So over to you, Sandeep, and thanks for joining in on a Saturday.
Yeah, thanks. So let me start with giving you some perspective. As you rightly said, Nifty at 60,000 and Paul's talked about it is a euphoric thing. So let me answer that. I think both the participants are correct, and I'll demystify this mystery in a sense which we look at from the behavior perspective. So let's understand when we talk about our BLRT framework, as we explained, is we capture for valuation analytics and liquidity analytics, risk appetite, and when the combination of 3 analytics skewed in one side, then we call it a timing. Okay, so timing is a very essential tool, but it is a skewed structures. Okay, whenever predictive analytics data is endorsing particular trend or particular patterns, okay, when we are looking at the market purely on number driven, the word quant comes from the background. Did we quantify everything? Okay, so let's understand what exactly happened. Let's say I want to take up the 2 scenario, what happened in March 2020, and let's see where we are currently. So the 2 scenario will give you a fairly good sense. Okay, in March 2020, and I'm looking at both India as well as global market. Okay, we have seen unprecedented COVID issues and market collapse significantly. India also, we have seen a lower circuit on 23rd of March and 24th of March. Market bottomed out, and since then market has recovered, and then we have seen a very massive bull run sort of thing. Now let's understand what happened by March 8. Okay, if I have to look at our framework of VLRT, nothing much change on the valuation front. Okay, the valuation parameters in those days were stable, because any change in valuation will reflect over a period of few quarters or few years, because in those 10 days nothing got changed except the fear, which has increased significantly. The risk appetite was at lifetime high for India as well as US and most of the majority of the global markets. Okay, when I say risk appetite, is nothing to do with the risk, and it is not inversely proportionate to the risk also. Okay, risk appetite is a reflection of your confidence level in the market, your conviction, and we all know by March 2020, people are worried about their life, and nobody was keen to participate even a penny in the market, fully knowing that this could be the phenomenal opportunity and a lifetime opportunity. You may not get it again, but the fear was significantly high. Okay, and can we quantify the fear and greed aspect? Answer is yes, as I'm going to talk about in the next few minutes. So let's look at the risk appetite extremely low, and rather from by the first week of April, we noticed that the risk appetite has made a lifetime low and recovering. Because of COVID and ongoing QE globally, we have seen extraordinary liquidity. So it was a classic scenario where liquidity lifetime high, risk appetite just recovered from lifetime low, and valuation numbers were stable. So when we give one-third weightage in our model, and it's also very interesting to know that though we talk about one-third, that is the ideal scenario, our numbers also change in a dynamic manner. Okay, as I said, there's no point in showcasing equal weightage model when there's nothing has changed on one of the most important parameter, valuation. Okay, in a crisis like this, our data point also change and adjust on some of the exponential data which we look at. Okay, on the exponential series. And that time, the risk appetite and liquidity was the highest level. As risk appetite bottomed out, in next 6 months, it was predominantly 80% was liquidity parameters were there. Okay. Now, I always say that when risk appetite is inching up from lower levels and liquidity is high, there's a lethal combination of a bull run. And that what actually played out very well. Okay. And if I have to go back in the history, something like another 3 instances that we can quote where these data points were matching. One was Harshad phase of 1992. Okay. After the peak of Harshad and the crash which we have seen later on, and which we talked about 2000, 2001 meltdown and followed by 2008. Okay. And now 2020. Okay. On all four occasions, okay, on all four occasions, our risk appetite declined something similar levels. Okay. If I go back in the history and try to showcase, see, nothing is works in the history like absolute number, because we all live in a dynamic environment and base itself keeps on changing. And hence we have to look at every data on a relative basis rather than looking at an absolute basis. As a student of science, I always believe the theory of relativity plays a role everywhere in our life. Okay. So these are the very interesting combination. Now let's look at, and we also nearly 15, 17 months of non-stop rally we have seen in India. And so is the case with global market. So it was not in isolation, but we have seen globally. Let's understand what has changed in 2020-21 and where we stand now. Okay. The liquidity, which was extraordinary, and I said lifetime high, started actually peaked out in the month of February 2020-21. Okay. And since then, I'm talking about global liquidity. I'm not talking about just India per se. Okay. Because India, the component is very, very small as compared to when we took a look at the share of the developed market, particularly, and US in particularly. If you can look at, they are like more than 65 to 70% this developed market in most of the calculation which we look at. So February it peaked out, and then in terms of percentage changes basis started declining till June, July, it started shrinking down. But if I have to say in absolute number, it was marginally drift only. Okay. So in absolute terms, the numbers was stable, but in percentage times, we have seen 8 to 10% fall also. But from a market perspective, this is good enough liquidity to drive index to the next level. Okay. So that's the first background. Let's understand where we stand now from the risk appetite. Okay. Risk appetite, which is, as you rightly said, is a reflection through a perception data, and it's talk about sentiments. Okay, this is one of the Maya parameters which we talked about. So let's try to dissect the euphoria part which was there. So we can measure euphoria through our behavior indicators. Okay, and as compared to last year and now, or maybe I have to say that euphoric indicator for global equities is on the closer to the upper band. It is not exactly at the upper end, but it is closer to the upper band. Okay. And that is very interesting. Okay. And what is more interesting is that when we talk about market valuations and other things, I just want to showcase a different perspective. Okay. How the perception plays a very important role when I'm talking about the sentiment data. Okay. In last 30 years of my career, I have never seen any one analyst showcasing what could be the valuation multiple in next 3 years, 5 years. Everybody comes and talks about based on certain assumptions. This will be the next 3 years earnings or revenue or cash flows, depending which were the financial data you talk about. Based on certain assumption, people can quantify up to large extent. Okay. But nobody comes and quantify what would be the valuation multiple, whether it's price to earning or EV to sale or price to book or whatever, or EV to EBITDA, any multiple which you can talk about in today's technology companies linked with more from the price to sales rather than any other parameter, but nobody tends to quantify. In fact, I have seen this is the more of a adjusting factor, when prices moves up and momentum is very large, people tend to justify by increasing the multiple by few percentage and the whole game changes. Okay. So we have worked back and try to create a behavior indicator, what we call it's a part of our perception analytics. And it's very interesting to know that when we talk about euphoria and then try to how we measure this euphoria, we measure this euphoria through the perception analytics. Multiple data points, but one of the important data points is the perception analytics. Okay. And what we notice is that that perception analytics for global growth is actually peaking out. Okay. When I say that there is a euphoria in the market, I agree with that part. But if you try to dissect this euphoria between growth and value, then you see you're able to differentiate it quite well. If there is a euphoria in the growth stock, answer is yes, but there is no signs of euphoria in the value stocks. Okay? And for me, there's a very important conclusion which we are drawing through perception analytics, and we work backward. And then we analyze the NASDAQ component, the new technology stocks globally, the MSCI technology indices for across regions that we talk about US, Taiwan, China, Asia, Europe, okay, and so-called new technology company which is there in the market, okay. What is very interesting to note that the perception analytics, okay, is like we have not seen that sort of spike in the perception analytics in last maybe in last 3 decades at least. I have not seen, okay, and then data points are very limited, okay. So this could be the one of the highest ever perception got built in the global markets. Okay. Now, whether we are saying whether it's peaked out, only since these are tools which we try to measure more on the monthly and the quarterly basis. So we'll generally look from a longer term perspective on quarterly perception data. And in maybe by December, you will be able to conclude much whether it actually happened or not. But if I have to use the predictive analytics tools, I can definitely say with good amount of confidence that the perception analytics are nearly to its peak. Okay, so we are at the cusp of peaking out. Whether it happened now, whether it happened in 3 months time, but somewhere it is very difficult to time it so precisely. But data points are indicating we are near to that event. Okay, let's break it further. What we are trying to say is a peak of global technology stocks or peak of the global stock. Answer is no. Neither we are saying that the prices are peaked out, nor we are saying earnings are peaked out. Okay, what we are only saying that valuation multiples are endorsing that their peak is very near. Okay, and that is the important judgment which we are drawing, or the conclusion we are drawing out of that. Because whenever multiple speaks out, okay, for any stock or any sector, they tend to underperform the market. The outperformer journey stops. Okay, so that is the one of the key conclusion we are believing that we could be in the final leg of growth stock peaking out from the valuation perspective. And this is the time to load up your value stocks in your portfolio and be aligned your portfolio in such a manner that even there's a euphoria which has been witnessed in the global market, we should not be worried about it. Okay, so this is more from a larger global perspective. Now let's come to India point of view. Okay, why? So in last 2 months or so, when we, even particularly last month, we look at when we have seen some amount of correction happening globally, which we have not seen in India, because two reasons. India liquidity is still inching up. India risk appetite is still rising. Okay, and this is one of the reasons why India has been one of the best outperformer indices globally. Okay, and as of now, there is no signs of any reversal on that also. Okay, which means that for a larger perspective, as of now, India, both growth and value, both cycle is still up. But when I look at the larger perspective, I always see people tend to follow the global market more closely, and the lag effect, Indian market will also adjust. If our global technology speaks out from the multiple perspective, I think with the lag effect, it will reflect in India also. Okay? Let's understand the from the US perspective. Okay, US and developed market risk appetite is significantly high, and as compared to Asia. And this is one of the reasons why we believe that from a next many years perspective, okay, we believe emerging market will outperform the developed market. And because it's also called represent, because emerging market also represent value versus growth of the developed market, and India will be the biggest beneficiary of that. And if I have to go back and try to analyze our timing tool on the money flow analysis perspective, money actually shift from high risk to low risk environment. Okay, I always quote this example, like, like energy never get destroyed, only changes its form. Okay, and similarly, as the way water flows from mountain to valley, similarly, money flow analysis indicated shift from high risk to low risk environment. With the help of QE, you can pump it and take it back again. But those are unnatural things. It can last only for a short term or medium perspective. But if I try to analyze the larger perspective of money flow analysis, okay, it clearly endorses that money will shift from DM, particularly US, to EM, and within EM, here India should be beneficiary. And even if 10 to 15% liquidity, global liquidity shifts from US, okay, to Asia, there will be tsunami in Asia. Okay, that's the level of conviction we are bringing from the emerging market perspective. And so is the case. We are also trying to link with the currency market, because ultimately currency market is the biggest market globally, and we give a lot of weightage on the currency market. The first life starts, our morning starts, try to understand what is happening in the global currency, followed by the credit market, followed by the commodities market, and then the fixed income, and the equity comes the last. So it is very important to understand where dollar is heading. Okay, and though we have seen sentiment changing with the dollar index, we have talked about in our book that 2020 will remember as a top for dollar globally, and it has worked very well. And we still believe that the larger trend of the dollar index is still down, and maybe right now it's in the consolidation phase. Maybe in second half of 2020 and maybe in 2023, you see a real big collapse of dollar is coming. So which also indicate the vulnerability of because currency represent the strength of a particular economy or particular country. Okay, and we believe our multiple macro parameters are endorsing that US is heading for a very, very difficult environment. Our challenge is not India. When I talk about global risk, my biggest worry is US, and everybody must be wondering when US is so doing so well, and why Sandeep is talking negative about the US market. Okay, so we believe that complacency, the Quant complacency index for US market is at lifetime high. This could be the highest ever, whatever data we have for many for last many decades. We have never seen this level of complacency in the US market. Okay, which also means that the vulnerability of US is equally high. Okay, what will change? People will not realize. Right now, Fed is preparing everybody for tapering. Okay, our view is that inflation is quite visible, and we believe this is not a transitory. In our book, we have talked about that 2021 onwards, you will see inflation and commodity prices will go from 2020. It played out very well. We still believe that the global inflation will remain, particularly developed market inflation, will remain elevated from second half of 2021 till 2027-28. And with this background, okay, commodities will do very well. With this background, emerging markets should do very well. And if inflation is coming back, then it will also dent the P multiple of the growth stories also. So that's another data point which we are believing that globally market, we are seeing a lot of fiscal stimulus happening. Fiscal stimulus is also inflationary in nature. Okay, and so multiple data points which you look at is all indicating inflation is coming. The disturbance in the supply chain, different disturbance in the freight charges, or significant issues happening right now in the freight industry are all inflationary. Okay, so it's a lot of people who believe this is a transition. I don't think so. I think inflation is there to stay for a long period of time, and we are in the camp who believes that US might see one of the highest ever inflation in this by the end of this decade. That's an aggressive view we have on the inflation. It's not our gut feeling. It is based on some of the predictive models which we have worked, and we believe it's unfolding and is done quite well in large. And a lot of earth changes which we talked about. So a lot of earth analytics data points is also endorsing that next 10 years, what I call it, from 2020 to 2030, will be the most wealth destruction phase globally. But it also gives you an opportunity. Okay? We call it from 2018 till 2023 will be the most volatile phase in our life. It will be the volatile expansion phase. And hence, your traditional styles of tools and technique will not be effective in this particular phase. Okay? And this is one of the reasons why we believe that buy and hold strategy will not be effective in this phase. We're not any allergy towards this strategy. Maybe we might adopt this strategy maybe in 2023 or 24 onwards if our data points suggest that. Okay. This is one of the background and genesis why we evolved a dynamic style of money management, where market environment is very, very important. When you talk about adaptive asset allocation, we believe that strategical and tactical allocation phase is over and the era of buy and hold is over. With this background, it's very important for us to understand what type of environment we are operating. And hence it is where we bring the concept of adaptive asset allocation, where we give a lot of weightage on the environment. It's very, very important to understand global environment. And in our book, we have talked about that global volatility, geopolitical volatility will rise, and we're surprised to know in 2020, geopolitical was a lifetime high. It was 100 years high. That's the level of geopolitical tensions we have seen in the markets. Okay. Now, anything which affects markets, okay, we try to factor that. Whether it's Earth analytics related geopolitical things. So when we look at our larger macro models, okay, we try to capture these things. It gives me far bigger edge because it really helps us to take a call in terms of understanding what type of risk on or risk of environment is there, whether it's an easy phase or difficult phase. Now, with this background, I would like to conclude few things. We believe that we are still in the bull run. In 2012, I coined this terminology called most hated bull run of the decade. I think that still continues. But the easy phase of bull run is over. Okay. And when I say easy phase, but bull run still continues. If we have now entered or soon will be entering the difficult phase of bull run, which means we will not see this sort of linear move which we have seen in from March 2020 till now. I think the expectation level of investor has to cool down significantly because environment has changed. And if we don't change, then we are inviting trouble by taking unwarranted risk in that. One of the reasons why we have increased our exposure towards more value stocks. Okay. We have growth also in our portfolio, but our portfolio currently is more skewed towards value. So we like some of the themes, like if you notice our portfolio, we have increased our exposure towards FMCG, we have increased our exposure towards energy, or capital goods, or even media, and some of the value themes which we have been talking about for a quite for like last many months now. I think time has come where this margin of safety in the most neglected territory, but quality names. We are not talking about anything which has not moved. You should be participating. Anything which is quality, particularly energy sector, we believe globally energy changes are happening, and you will see some of the existing company will transform into a towards green energy. Ultimately, energy company will only change. It's not something new will evolve overnight. I don't think it's going to happen like that. Okay, so you will see radical changes happening. You will see re-rating of these sectors which is there. Okay, and if US market for whatever reason of underperform for 1 quarter or so, or maybe 2 quarters, you will see money will shifting towards Asia and emerging market. And relative to China, though we are constructive China from a given the background of Asia, but China has its own problem. And if China as a country is in trouble, it's a great news for India because globally people don't run just India-centric fund. They are emerging market funds or the Asia-centric fund. And if for whatever reasons, given the current background and turmoil which we are seeing in China, if their weightage get reduced in terms of allocation, then India is beneficiary. It's a very natural beneficiary of any crisis in China. So I generally feel very happy and relaxed when you see issues in China because we know we are going to be beneficiary of that. Okay, and and as of now, China yuan or China economy is not as important from a larger global perspective. Is not that integrated to interlink like a crisis of Lehman moment sort of thing, which people were worried about it. Lehman was a more of a liquidity crisis globally, and which is not the case right now. We have surplus liquidity globally. So I don't think any like Lehman-like scenario can even visualize for by it's just a biased opinion or people get too tempted to talk about these things. Okay, I personally believe market is going to be very volatile. Data points are changing very rapid manner. Okay, and this is the time you have to be very nimble. You have to be very flexible. And as a house, we try to gauge these things, okay, through our predictive models, and hence we are early in some of the stage. Like we have recently seen a real estate boom happening. Realty stocks have performed very well. We have been holding for last many months. We an average 10% exposure to most of the scheme on the realty side. So sometimes you have its own advantage and sometimes disadvantage also being early. Like August 15th, when market fell, we fell more than the market because we have more skewed our portfolio toward textile, realty, and metals. Okay, and we have seen that fall, and now you see the recovery was equally quick. So we are beneficiary of that also. Okay, so the way I look at from market is a challenging time. Answer is yes. Okay, But I don't think one should be too much worried about, because next few years still looks very interesting for India. India is in a very, very sweet spot. So capital goods or textile or India-centric themes will do extremely well from a longer term perspective, and any dent to China will be beneficiary to India. So I think it's a, as an opportunist, uh, one should be very, very flexible to optimize this opportunity which is knocking our doors. Okay, but and also market participants in general are very much worried, as you rightly said. I don't agree with this. When I people saying people this poll talked about euphoria. Market never peaks out with this level of conviction. Okay, I can quote all examples of 2008 or 2000. Okay, if you could have conducted this poll, you could have not got this sort of data points. Okay, when everybody believes that every markets are peaking out and especially at the peak of the cycle, consensus get built, and that's the reason you see it because India is becoming like buy on dip market, because every level people are thinking there's no euphoria right now. Okay, only euphoria we have seen in that too in last 1 month or 15 days particularly. We have seen euphoric moves in the technology stocks. We have euphoria moves in the large cap market. Rather small and mid has corrected much earlier. Okay, so unless we see a collective euphoria, which is not the case right now, we will not like to take any aggressive view in claiming that this is the peak of the market. Okay, I think we are in a very comfortable situation for next many years perspective in India, but the sector rotation, stock rotation will play a very important role, and hence we are more skewed towards our dynamic style of money management. We are using our VLRT framework with the help of predictive analytics model, and money flow analysis really help us to have this edge, okay, in spotting some of the sectors at much early stage. So you have to also understand that when we are early, okay, sometimes you are also seeing the pain also being early. We were 2 months early in ITC. Okay, I'm just giving you an example. Generally, we don't talk about stock, but look at from behavior perspective. People have started writing jokes also on ITC. WhatsApp messages are full of ITC jokes. Okay, so it means it has reached the most desired, neglected. It's the most stock which was generate so much cash was in the neglected territory. Okay, and when you see these extreme, so is the case which we happen in the Z or Sun TVs of the world, or the media sector, and you see what is happening. Okay, I'm just giving you an example. Okay, how when sector or stocks get reach a most hated territory or neglected territory, and then the rebound with some events, it is a very ferocious move you see. So we're trying to preempt not only these moves. Okay, when data analytics are endorsing these things, we are early in taking that opportunity, and so we will be early in spotting this opportunity, and we will be earning and exiting that opportunity also. That's the way we operate, and that's the reason sometimes you see when market was very euphoria happening in the banking space in January, we underperform. So is the case with August now, when technology stock we have seen euphoria. We were early to tone it down. We have underperformed, but that's the way we work. Whenever, because our focus is to uh, give better risk adjusted return, and we see any sort of signs of euphoria, we better trying to prune it at early stages, and before it reach a classic top, and you may not get an opportunity, because ultimately we are all human beings. We'll get sucked up at the price movement. So that's the way we look at it. Okay, so I think that's the way I have concluded it. Okay, from my side, we are very open for any question answers.
Thank you, Sandeep. I think very, very interesting. I think very engrossing. So I just have one question, since you have been talking about the US market, and we are seeing a lot of currently interest on the international funds in the Indian markets. Like we are seeing a lot of launches being happened for on the developed market. Now, since you have a lot of players which are like you have the Googles of the world, which are listed on Nasdaq. So when you talk about that US will have a problem as a developed market, what about the US market? So you think the US markets would also underperform, because now these are all stocks which are which have markets across the globe. So like Google and Facebook, we also use it. Amazon, we also use it. So do you see the US markets also underperforming?
So I agree. Most of the US companies are global in nature. They are not just US centric. Okay. But US being the mother of all exchanges, and something goes wrong, okay, in US, okay, then definitely it affects global markets. It affects global equities. It affects growth stock particularly. Okay. And with a lag effect, you will see impact happening globally. Okay. My worry is it's not something that we are seeing that is going to happen in immediately is it happening, but early signs of those data points, or if I have to call it early signs of disturbance have come. Okay. Let me give you a small example. When global liquidity peaks out, okay, the impact is not felt on immediate basis. Okay. The impact will be felt. This is some of work which we have done for last 30, 40 years. We try to say that it's all about the impact of this peaking characteristic of liquidity will be felt with a lag effect of 15 months, sometimes as high as 18 to 21 months also. Okay? Because if you try to dissect the liquidity into various components, particularly the good liquidity or bad liquidity, okay, in today's context, uh, even the central bank liquidity, which is considered as a bad liquidity, is considered good in the environment which we look at. But historically, people used to consider it quite bad, when the central bank intervention is there, is a temporary in nature, okay. But how dynamics changes, okay, people started looking at the total liquidity component instead of segregating separately. But when we try to dissect and try to see how we look at the good liquidity from the private sector point of view, or from the productivity point of view, or the efficiency point of view, or any other economic terms which you want to use it, okay, we believe that it is a scenario which is building up, and one has to be very careful about it. And as you rightly said, when whole world is introducing US centric funds and developed markets, and it's another classic sign from the behavior finance point of view, okay, that's easy to sell. Money managers and the manufacturer and distributor will able to sell a product which is easily acceptable. Okay, it is also a reflection of that mindset. Okay, US market is on bull run from 2000 August 2012. Okay, and then massive move we have seen. Okay, and if people are participating now, this is also a sign that complacency towards US stocks or developed market stocks globally is on a higher side. So I'm not very surprised to see that phenomena unfolding in the market. And our advice is that it's a time to focus more on emerging markets, a time to focus more India centric rather than focusing on the US centric right now, as I believe vulnerability is high. And when we look at the larger macro perspective on dollar, and we have even as strong as view is that over a period of time, US dollar will not be a reserve currency for global markets. Okay, we have as strong as views like that Fed will not be relevant, okay, in many years. So we said that 2020 onwards to 2047, US will lose its reserve currency status the way Britain has lost after 1960. Britain has lost the relevance as a country, as a superpower. Okay, so a lot of things will change, and if US, so we are not saying that US become irrelevant, US market will become irrelevant. Okay, ultimately, I said in the beginning, it's all a relative game. Okay, if I can get better returns in the emerging market, if I can get better returns in India, then why to venture out? Okay, so it's a good to have a diversified portfolio. Sometime an opportunity was big. Right now, based on our analytics, we think we are in the fag end of that. Whether it can last for a year, whether it lasts for 6 months, is very, very difficult to pinpoint. Okay, when we get these early signs of disturbance, we will like to play a cautious game rather than saying let it peak out, let it correct 20%, then I will take a call. Okay, that's not the way we operate. I hope I will able to answer that.
Okay. Yeah. Okay. So, and just one question. I mean, when you mentioned about ITC, I don't know whether if you are in a position to answer it, but what was the rationale behind you taking ITC? I knew we had all the jokes going around on
Yeah.
WhatsApp on ITC, so I'm sure that was not the reason to buy ITC. But
No, we don't buy stock based on, so from the behavior point of view, it was very evident. I just took the example. Generally, we don't talk about stocks. Okay.
I know. I mean, so
Okay. But because it has reached that stage, jokes are getting cracked. On one of the largest cash flow generating company used to be at some point, top three market cap company by in 2020 and 13. Look at where it's come up. So the way we look at any other stock, ITC was also qualifying in our neglected territory. So if the stock was a life, it has reached a neglected territory. So we have a from a behavior perspective, we classify the stocks into multiple behavior buckets, like most admired category, most neglected category. And when the intensity some of the growth stocks are in most admired category right now, okay. And when you reach this, ITC also has a history. There's a good part is that from 1992 or 93 onwards, we have seen ITC being listed. Okay, so if you have a history of a large market cap company, so we have our own behavior indicator which was endorsing it is in a most neglected territory. So this is one of the reasons we were tempted to buy, and some model was suggesting that, and that's the reason we have took a very sizable exposure in last 3 months or 2 months particularly, and in last 1 month particularly.
So, Amarnath, you want to ask a question?
Yeah, Sandeep, you covered almost all the various factors that people do look at, and you talked about the predictive thing, but clearly many of the factors are non-predictive. I mean, things turn on a dime, whether you talk of the global financial crisis, pandemic, the crypto factor, China's crackdown on digital, then the whole Robin Hood Reddit kind of behavior to investing. So these are all things clearly not non-predictive. So how do you adapt them into your quant models, and how quickly do you have to keep rejigging them in the last few years particularly?
Okay, so I have a very interesting answer for that. Okay, I define normal investor and informed investor. There's a very thin line between insider and informed. Okay, so we are talking about informed investor. Okay, a steel trader is a informed investor for steel industry. Okay, a auto ancillary guy who himself is producing auto component is an informed investor. If he is an investor, he's an informed investor about the auto ancillary space. Okay, and the analyst community or the fund manager community or the media is the last to come to know what exactly things they want. Okay, so when we believe on our behavior analysis, we try to filter the smart money and the dumb money. Okay, and smart money is not about money manager who has capability. We don't have that capability. Okay, because as a money manager, practically it is impossible for us to be specialized of all the sectors, even despite you can get the best services of the rated analysts in this country. Okay, but we believe the person who is actually involved, okay, whether it's the manufacturer or the trader himself on particular commodity or particular components manufacturer, they are well informed. Similarly, when we talk about global challenges, whether the first reflection is reflected in the currency movement, it's reflected in the credit market movements. Okay, when you try to analyze the second and third derivative data, okay, unfortunately, in India, it is not capital account converter is there, and amount of data is not there. Okay, but when you get into global markets, okay, and you try to dig deep down in these markets, you will get a fairly good handle. Okay, I agree with you. Is nobody can quantify and predict. Okay, this events are going to fall. Like in our book, we have talked about in 2012, we have written that market will peak out, okay, in 2020. Though we have written in 2012, okay, and it actually peaked out in 2020. Okay, why it happened? Because some of the cycles which we work, okay, we are great believers of cycle theory on multiple macro cycle or the climate change cycle. We look at a lot of data points. We run multivariate models on that. Okay, and we spotted a lot of things are endorsing that something is triggering in 2020. Okay, we didn't know in 2012, and the biggest thing which we talked about how commodity prices will come up because we believe that agri prices will go to the roof. That is the base formation in 2020. We wrote in 2012 about it. Okay, now it's only possible when, with the help of predictive analytics, you try to connect the dots. Okay, it is very, very visual, difficult to say this will happen, but if you connect the dots, you can feel something like this is emerging. So it's like a continuous task. As of today, based on our model, we try to see what is picture which is emerging for future. And the advantage is that if you can foresee that thing coming, you are more mentally prepared, and then you can tweak a bit and be prepared. It's all about preparedness rather than saying that, so like, I'll give you a small example. So in 2020, beginning 2020, we were very clear. This is and in our book, we have talked about recession coming in 2020. So we started pruning down leverage economy stocks over our portfolio. So we started selling metals or banking or cement, okay, and we were more skewed toward export. We are more skewed toward healthcare, more towards pharma and specialty chemicals. So it was a strategy based on our models which we are endorsing. We didn't know anything about COVID in January 2020. Okay. By March 2020, we didn't have any of these exposure, including banks we toned down. Okay, we didn't have, I don't think we have ZIL's exposure in the banking names, okay, despite it was 40% to the market, but we have only insurance company and some of the AMC companies in our portfolio. So it's a call which we took on based on data like September 2019, just 3 months prior to that, January, when we took this call, we spotted that pharma sectors has reached the most neglected territory. When in March 2015, the pharma sectors or stocks was the most admired category. By September 2019, they were in the most neglected and hated territory. Okay, so we build up exposure towards chemicals and pharma's portfolio, which paid off in the COVID crisis. So when COVID unfolded, when market hit a circuit, we also fell, but we came back quickly. And then our ability to spot the risk appetite and liquidity data points really help us in taking a call towards mid and small cap. That's the reason from June onwards, we started loading up mid and small in our portfolio as compared to large cap. And this August onwards, we have increased our exposure towards large cap and pruned down mid and small cap, because we felt in the first week of August, we spotted that impact cost is increasing in India. And hence we decided to prune down the exposure towards some of these names and just trying to control illiquidity risk in our portfolio. So it's a very statically, data-driven thought process which we bring to the table. And one of the reasons we do all these things, and hence it lead to good amount of churning in portfolio. Okay, and this is another myth which people talk about. We churn our portfolio. Ultimately, everybody has to look at the risk-adjusted return. Whether I'm able to control my risk properly, and if I have that ability to churn my portfolio, because we have tax efficiency in our favor. Okay, it's the best vehicle which we can optimize it. Okay, and hence we optimize any tools which is available for us. Okay, so it's all about ability to connect the dot and see how things. So we work on so we tend to preempt answer is yes, but not just on a gut feeling, but on some of the predictive models which we run. So it's a very process-driven thought process organization. What we do, there's a logic. Okay, and 70% time, 80% time we get it right, 20-30% time we don't get it right, and that's bound to happen. Okay, so we follow that process, which has helped us in giving this outperformance. So we'll maintain with that.
Thanks, Sandeep. That was very, very
I'm just taking a few questions.
Process.
Yeah, I'll just take a few questions from the audience. So we have one, that are markets in sync with the economy, and if not, are we at a risky level? So if a person is entering at 60,000, what are the returns is expected with a time frame of 1, 3, and 5 years?
I think the way we are looking at market, I said that India particularly is in a very, very interesting space, about infrastructure spending, with a Prime Minister dream to talk about green energy and amount of capex which is getting built in this country. And I think the last few years, we have seen some amount of changes which is happening with the GST, and the reflection is there in terms of increased tax number. I think infra is the opportunity. Okay, I strongly believe capex cycle is coming back. Okay, because and it's not just my belief, is backed by some data, because in last 10 years, people who are tempted saying that capex cycle is coming back has been disappointed. I think infrastructure as a portfolio, maybe our infrastructure fund, we have been very vocal about it to push that product, because we feel this is the great opportunity if somebody is coming at even at this level, because if the capex cycles is in a very, very early stages. Okay, now if sometime obviously valuation looks slightly stressed, some of these company, the moment you look for next 3 years perspective, then they will find it they are not that expensive when you compare to look on the trading basis. So I think that's the way I look at the opportunity. I think Infra is the theme one has to play out in a very aggressive manner if somebody is participating even at this level of 60,000. Okay, I think infra is a theme which you can play out. On immediate basis, we are more optimistic on the large cap companies. So maybe our infra fund or focus fund look at. And just giving you a smallest example, our infra fund has given one of the highest return in the thematic space. Okay, it has outperformed even the technology funds and pharma funds or any other fund. Like technology has been the best performer funds in last many months. Okay, so infra in last I'm talking about from March 2020 lows. Infra fund has given one of the highest return despite it is not a technology fund. So that is the very subtle way of I'm getting a sense like our infra fund itself is giving this sort of returns. It gives me also endorsement of that opportunity, and plus our macro data points are very, very constructive for India capex cycle.
Okay. And another one question is that you spoke about the adaptive asset allocation and dynamic approach, and it is no longer about buy and hold strategy. So are you suggesting that retail investors should have a short-term investment horizon?
So I will say, it's not about just a short-term horizon. It's about the entire thesis. Okay. And the thesis is like, I come from North, we have been taught, just put money in real estate, go to South, people just say, just buy gold. Okay. Go to West, people talk about the equity market in a big way. Okay. So it's like what sort of environment we are coming in India and globally we have seen, because when markets are in the very early stages, okay, so buy and hold has made extraordinary money, and people who have made extraordinary beliefs always going to come and educate, because that is a thesis which they have believed and they made money out of it. Okay, and that was the case. But we believe now world is very much interlinked. Okay, and data points is changing, and if we believe that at least our model, we have suggesting that 2018 till 2000 will be very, very volatile. You saw 2018 was the most difficult phase. 2000 very volatile. 2019 was slightly better, but 2020 was equally bad in terms of volatility. Beginning 2020, asset class is still very volatile. Okay. Now, I am not a very strong believer of particular thesis. It's all about that environment which is suggesting me to look into these theses. So it's all about that you should understand you have multiple tools available for you. Okay, but it's very important in what environment those tools are more effective. Okay, so we are not endorsing that one should get into a trading mindset sort of thing, but if you are able to capitalize on these cycles when you see euphoria in particular sector or stock, if you are able to churn and move towards value or move towards under owned or under research or under quoted stocks at that stage, but it's not easy. This is based on your research and somebody was want to do. I'm not talking about just flipping in their portfolio and churning your portfolio, but it's a opportunity. We think it's a money flow analysis. If somebody has the deep understanding on the market, I think this is an opportunity to play. Okay. And globally, buy and hold funds have underperformed the market. Okay, and you look at when you talk about Robinhood era or US thing, when high frequency data is there. Okay, churning in US is not considered as bad as the way people perceive in India. Okay, it's like a taboo out here. Oh, he churns. Okay, so it's not. It's all about when the activity level is so high. Best of the global fund managers, the churning has increased because market has become so dynamic. They are able to adapt when technology is driving. Okay, machines are running, algos are running. Okay, they are much more faster than the human beings. Okay, so you have to adapt these changes. If you don't adapt, then market will make you irrelevant.
That's why your theme is being relevant.
Yeah, that's true. It's very important to keep that theme because, and it's not easy to retain that. Every morning I come and say, yeah, we have to keep ourselves relevant.
So, which sectors? I mean, so there have been there where which are the sectors you think would are either they are neglected or where do you see a rally happening now going forward?
So, as I said, the value is the theme. So it's not about sector like We took the example of ITC. ITC at some point used to be a growth in FMCG hotels and then became a value. So is the case with some of the companies, which used to be considered as a growth story and over a period of time become a value. So you have to look at the value stocks because that's the thesis which is coming out. So obviously value is there in typically old economy stock, value is there in the energy space, value is there in the realty space because they are beaten down and neglected territory. Value is there in the capex cycle, value is there in some of the old economy stock which I'm addressing. Okay. And within banking also we have seen there is a value in certain banks. Okay. So some of the banks are growth banks and some of them have become a value. So you have to identify the value. Okay. So that's what we are able to differentiate. And it's a very subjective also, somebody can say for me this is a value and somebody can say for me this is a growth. It's how you look at it.
Okay. Amana, do you want to take up any last question? You're on mute,
Yes,
Amana.
yes. I think the Quant presentations talk about something about turnaround situations, right? And particularly with bad bank and the IBC and all those things happening. I think if you could just share with us some of the secret sauce ingredients on how you select investment worthy turnaround situation. I mean, the turnaround situations are plenty, but most of them end up, causing misery.
So see the way Avana, is a very good question actually, and I have also seen, some of stock which has corrected and we saw this every time people felt this a great value and then it corrects further and becomes deep value and it further corrects, it becomes further deep value. Okay. So so value keeps on increasing, but the fall is so meaningful. Okay. That it tests your patience exactly at the bottom of the cycle. Okay. So a lot of people who have been, this is something what we call it the capitulation of value investors. Okay. And we have seen it very recently also, how some of the managers are holding these stocks for a long period of time, virtually at the when cycle turn, they have been capitulated or they have been pruning the exposure in these cycles. Okay. So what we bring to the table, which is very unique, is like that's the reason we say we give only 1/3 weightage to the valuation analysis. Okay. 2/3 weightage is all about liquidity and sentiments. Okay. So we have built a lot of liquidity tools for these companies, and we have also built sentiments data or perception data about these companies. And when we spot that, like ITC was the very classic example we talked about. Okay. It qualified. Valuation was attractive. It was attractive at 300 also. It was further attractive at 200 also. Okay. So it was deep in the value. So what we felt, our perception analytics was endorsing that now it has reached the extreme level of negativity. Okay. And the liquidity data also was endorsing some of these characteristics. Okay. When I liquidity indicator, we are trying to see how the capitulation is happening, how the under ownership was increasing, So people who are holding for a long time, they were getting capitulated. When you see these changes happening, okay, in a very quantified manner, okay, then we felt, it's a combination. And then jokes was the additional data points which was there. It just endorses your behavior thesis, and it was very embarrassing to see some of the senior management on the TV have been talked about certain things when the value will unlock, Okay. So it was a very classic combination. When you get these things, it gives you an opportunity. Look at today. I think there's a deep value in the capex cycle stories. Okay, there's a deep value in some of the PSU stocks also. Okay, particularly stocks where they are dominant leader or they are in a very dominant positions. Okay, as compared to just PSU banks. Okay, which not are in dominant position in anymore. Okay, maybe State Bank would be the exception in that case. So we have to identify some of these names where value is there. Okay, and there could be opportunity. What is changing in the? So I think if overall capex cycle improves, I think realty stocks also you look at the derivative of realty sector, the derivative of infrastructure sector. I think those are the areas where you will make big money. Okay. Now, big is also a very, very subjective thing. Last year people have got spoiled. The definition of big money has changed. Okay. The 10-20% expectation has become 100-120%. So that also has to be curtailed and brought it back to the normalized level. So there are opportunities.
Thanks, Sandeep. That was very insightful.
So I will just take the a last poll where it's basically, it's like, post hearing, Sandeep, what would be your call on the future investments? So would you hold, would you add more, or would you exit? So if, I think we had in the beginning we had nearly 62% of the investors, talking about that we are in the euphoria. So we just thought that we will have another question based on post hearing what you had to say. What would they call on their future investments? Give it another 15 more seconds. Okay, just sharing the results. So we have a 44% of the people will hold on to the investments, 45% would want to add more, and 11% would still exit. So I think there's I think there is some change in the perception from what it has been to from the euphoria. I think people are looking at holding and adding more. I think so that's a good sign. So thank you, Sandeep, for very,
Looks
very
like that I've done a good job then and convincing people.
absolutely. Absolutely. Yeah.
Correct.
You have been absolutely relevant in terms of the decision making, and very insightful, in terms of that where you say that you actually quantify everything. So that was a key, take for what I would have. I've just noted down a few points which were your key takes which were there, and I found it quite interesting. Risk is about your conviction. So yes, absolutely. And money would shifts from high risk to low risk. It just keeps on changing the character. A very good point. You see US markets not doing too well, specifically the economy, and the economy front, that you see inflation rising, US not being the reserve currency, and these are very bold statements. I like your dynamic style of management, that you have to be nimble. Buy and hold may not work in the current market scenario. Uh, you don't see India currently in the euphoria stage. It's a little bit time to catch on. So that's some good news out here for people to stay invested. And so the only thing is that we will not be in the easy phase. Markets will be very volatile. So I think everyone will have to be very careful in terms of not being caught on the wrong end of the volatility. And India is in a sweet spot. Problems in China is good for India. Good statement. And I think that's about it. And markets volatility phase will continue till 2023. So I think we are in for 2 years of volatility. So thank you, Sandeep, once again for joining us on a Saturday, and thank you everyone for participating in this webinar. And I hope you find it useful.
Thanks, User. Thanks, Aparna. Thanks, everybody.